Why has Greenland become the focal point of political negotiations? Yet, the hidden angles buried deep within this event are the very issues shaping global economic objectives. Let's follow the in-depth analysis below. Sunday, January 18th, 2026. You open your phone like every other day. The news pops up in front of your eyes, and it is strangely funny. Greenland. Greenland again. People chuckle as if history has just been dragged back into an old joke. Commentary shows rush to create memes, interview Danish politicians, compete for shocking sound bites, a circus in the truest sense of the word. If you only look at the surface, you would think, oh, just another political stunt to grab views. And honestly, a week earlier, if someone had told me that the global silver market could be shaken just because of a story about buying an icy island in the North Atlantic, I probably would have told them to check their medication. But pause for a moment, because while the media is laughing somewhere else, no one is laughing at all. London and New York. Rooms with no cameras, no applause, only screens, spreadsheets, and risk warning lines. The logistics teams, the risk departments, the treasury desks of major bullion banks are staring at a short line in that very same tweet. One sentence. Not Greenland, not the stormy statement, but the line about tariffs. 10% import tariffs on goods from 8 European countries, including the United Kingdom, starting February 1st. And if no deal is reached, that rate could jump to 25% on June 1st. To ordinary people, it sounds like a trade dispute. To risk managers, it feels like someone has just erected an invisible wall in the middle of the Atlantic. Can you picture this scene? A shipment of silver sitting somewhere near JFK, crated, shrink-wrapped, ready to fly. The phone rings. New order. Stop. Stand still. Do not ship it. Because if it leaves U.S. soil, it might never come back again. At least, not with its profit intact. And when the physical flow is blocked, the next thing to be blocked is price. The thesis of this video is very simple, but its consequences are anything but simple. A tariff that appears political has shattered the mobility of physical silver, and when silver can no longer move, the global market is immediately fractured into separate regional markets. What must be emphasized from the outset is this. We are not trying to guess where silver will open in dollars on Monday morning. That is a short-term question and a distracting one. What we are analyzing is structure, the mechanism operating behind the price screen. Because if that mechanism is broken, every number you see afterward is merely a consequence, not the cause. In other words, silver itself has not changed in nature. What has changed is the ability to move silver from places of surplus to places of shortage. And when that disappears, one market becomes many markets. There is something the major news outlets will not tell you directly. Not because they do not know, but because it does not fit the breaking news format. The Greenland story is easy to tell. It has characters, shocking statements, comedic elements. But the silver market does not run on memes. It runs on logistics, costs, and dry realities that television rarely wants to touch. On the surface, this looks like a trade dispute, tariffs, negotiations, politics. But at a deeper layer, this is a direct strike on the physical pipeline connecting the two largest Western silver pricing hubs. A strike that requires no bombs, no export bans, only a change in expectations about the cost of returning metal home. 10%. It sounds small, but in the world of bullion banking, that is not a fee. It is a death sentence. Margins here are so thin that a small slip is enough to wipe out an entire year of trading. When you force a bar of silver to pay ransom just to return to where it came from, you do not merely slow the flow, you make that flow financially toxic. This is the part algorithms do not understand. They are programmed to look at interest rates, the dollar index, industrial demand. They are not taught how to react when a shipping route once taken for granted suddenly becomes an asymmetric risk. There is no model for a situation where sending it out works, bringing it back kills you. And so, while the media is still joking, the market has already shifted into defensive mode. No law needs to take effect. The belief that it will take effect is enough. In finance, fear precedes reality, and sometimes that fear itself is what breaks the system. Before going deeper, we need a quick map. Not to memorize, but so you always know where you stand in this story. who the players are, what is being threatened, why it matters, and ultimately, who will pay the price. Start with the who. At the center are the major bullion banks, institutions that live by balancing metal between vaults. On one end is London, where enormous volumes of physical trades are settled every day. On the other end is New York, where futures contracts set the pulse of price. In between are the risk, logistics, and treasury departments. The people who never appear on TV but decide whether metal moves or not. Further out is Asia, especially India and China, where physical demand is pulling silver like a pump with no off switch. Next is the what. What is being impacted is not the immediate price, but the ability to transport silver across borders without second thoughts. This system exists on an implicit assumption. Silver is silver, wherever it is, and if needed, you can always bring it back to where it belongs. Tariffs break that assumption. They turn a route once considered safe into a one-way gamble. Then comes the why. Why does this matter so much? Because London and New York are not just two cities. They are two pricing centers. When silver can move back and forth between these two places, prices are kept within a band. When it cannot, prices begin to reflect local scarcity. And when scarcity is no longer shared, it becomes dangerous. Finally, who pays the price? London tops the list. Vault inventories there were already thin due to flows toward Asia. Losing the supply line from the United States makes them the most vulnerable. Investors holding unallocated silver also face greater risk because there may not be enough physical metal when everyone demands delivery. In the United States, buyers of physical silver may still see shelves stocked, but buyback prices, the replacement cost, begin to rise due to tariffs on refining and imports. And the banks? They pay with something even more painful than money: certainty. And in finance, when certainty disappears, every model begins to wobble. With this map in mind, we can now move into the most important part: how each piece connects to the others to turn a line about tariffs into a trap. This is the longest section, and also the most important. If you listen to only one part of this entire analysis, it should be this one. Because everything we have just discussed, tariffs, Greenland, headlines, only truly makes sense when you see how each piece operates in the real life of the silver market. Not on charts, but in vaults, on airplanes, and in the spreadsheets of risk managers. Number 1. What whack-a-mole really is. In the ideal world the market has been accustomed to for decades, silver is never scarce. At least, not on paper. When New York heats up due to rising demand, prices tick higher. Bullion banks do not sit and wait. They open vaults in London, pull silver from LBMA vaults, load it onto planes, and fly it straight to New York. If they are fast enough and move enough volume, they can put out the fire in price with physical supply. When London is short of silver, and this is happening now, they do the reverse. They pull silver from COMEX vaults in New York, fly it to London, and restock shelves to fulfill physical contracts. This game is informally called whack-a-mole. Wherever something pops up, you smash it down with metal from somewhere else. What must be understood is this: they do not create silver. They only move silver. The sense of abundance in the market does not come from new mines or increased production, but from the ability to reshuffle metal fast enough to create the illusion that supply is everywhere. As long as planes are taking off, the game continues. The problem is that this game survives on one single condition: outbound and return flows must be symmetrical. Sending it out must be easy, and bringing it back must also be easy. If one direction is choked off, the entire game collapses. The bridge to the next piece is clear. What happens when the U-return leg suddenly becomes so expensive that it is unacceptable? Number 2, how a 10% tariff destroys arbitrage. It sounds small, 10%, but place it in the proper context. Suppose silver is trading at $90 an ounce. 10% means $9 per ounce when importing it back into the United States from the United Kingdom. $9 is not an operating cost. It is a direct slash to profit. In bullion banking, margins are usually measured in cents, not dollars. A successful arbitrage trade might earn a few tens of cents per ounce. When you suddenly add a $9 cost, you do not just make the trade unattractive. You make it mathematically impossible. This creates a deadly paradox. Sending silver from New York to London is not taxed, but bringing that very same bar back to New York is heavily taxed. In other words, silver can go out, but it cannot come back without bleeding capital. For risk managers, this is a nightmare, not because they hate taxes, but because they hate asymmetry. A risk that cannot be hedged is not a risk, it is a trap. And when a trade shifts from low profit but certain to large loss if you turn around, the next reflex is unavoidable. Number 3, trapped inventory and the export stop. We often think markets react when laws take effect. In reality, the opposite is true. Markets react when expectations change. The moment the tweet appeared, the moment a 10% tariff became a real possibility, risk desks acted. There were no press conferences, no loud announcements, just internal emails and short calls. Stop all outbound shipments. The reason was simple. If you are not sure you can bring silver back, you do not send it out. This is when the concept of trapped inventory emerges. Silver sitting in US vaults suddenly becomes stuck silver. No one dares to move it across the Atlantic, because once it crosses, it may be trapped on the other side with an unbearable cost to return. The key point is this: no law needs to be in force for this to happen. The belief that the law will be enforced is enough. Logistics does not wait for legal text. Logistics waits for risk probability, and when banks simultaneously take their hands off the controls, the pipeline connecting the two largest pricing centers in the world is cut. Not by an export ban, but by rational fear. The next bridge leads straight to the most vulnerable point in the system. Before, London was already weak. And the cavalry doesn't arrive. London entered this shock in far from healthy condition. For many years, silver has been steadily flowing from the LBMA toward Asia, especially India and China. That flow has not been loud, but it has been persistent. The result is that physical inventories in London have thinned significantly. Under normal conditions, this would not yet be a disaster, because when shelves run low, London can call New York. Send a few million ounces over here. And New York has done exactly that, time and again. That was the cavalry. And London had grown accustomed to the cavalry always showing up. The problem is that this time, the cavalry does not arrive. Last week, about 4.2 million ounces were withdrawn from COMEX vaults. Many people assumed that silver was on its way to London. But with the tariff wall that has just been erected, there is a very high likelihood that this silver is standing still. Sitting in vaults, waiting for a decision. For London, this is a disaster. They have sold silver they were counting on being replenished. When the replenishment source is cut off, the question is no longer at what price, but where do we get the silver to deliver? And when a physical trading center is no longer certain of its ability to deliver, risk does not spread slowly. It spreads like fire. This leads directly to the biggest consequence, and also the one the market fears most. The 5. Bifurcation. One asset, two prices. Imagine a scenario that sounds absurd, yet is completely logical in this context. Silver trades in New York around $90. At the same time, in London, silver is being offered at $110 or more. Not because London traders are crazy, but because silver there is scarcer and it cannot be arbitraged from the United States to pull prices down. In a normal market, such a spread would be eliminated within hours. But when metal cannot move, the spread remains. That is bifurcation, the fragmentation of the market. For banks, this is a nightmare. They typically run global books, long in London, short in New York, or vice versa. When prices between the two locations diverge sharply, the hedge breaks. Losses appear precisely where they previously believed they were safe. And then they must choose. Keep silver in New York to protect the US market, or send it to London and accept that the metal may become permanently trapped. They cannot do both. For most banks with headquarters or major interests in the United States, this choice is not difficult. They will protect New York. And that leaves London facing the metal hunger from Asia directly with no remaining lifeline. One asset, two prices, and the law of one price, something we once took for granted, is broken not by markets, but by geography and tariffs. And it is here that the story turns. because what looks like a random blow begins to reveal a consequence. That is strategic in nature. At this point, the story begins to pivot in a direction very few people are paying attention to. On the surface, everything looks like a policy mistake, a controversial statement, a tariff that seems arbitrary. But if you set the headlines aside and look only at the consequences, a very different picture emerges. By making the export of silver financially risky, this policy has accomplished something without any strategic declaration. Keeping silver inside US borders, not through bans, not through nationalization, but through cost. And in commodity markets, cost is often more effective than command. Pause here for a moment, because this may sound hard to believe. We are accustomed to the idea that global markets always seek to optimize, that metal will flow to where the price is highest. But that is only true when the flow is not penalized. When every trip carries a risk of losing 10% of capital, optimization turns into suicide. So what is the result? Silver in US vaults becomes a form of domestic strategic reserve, even though no one calls it that. It remains within the system. It is available for industry, for minting, for domestic buyers. Meanwhile, London, the distribution hub for the rest of the world, is forced to fend for itself. Here, another paradox appears. In the short term, silver not leaving the United States may slightly ease the sense of shortage. Shelves do not empty immediately, but at the same time, replacement costs rise. Refiners in Europe and Canada face tariffs. Premiums increase. The street price separates from the screen price. And then you realize, this is not just a story about silver, this is a story about resource nationalism in a new form. No slogans are needed. Simply make exporting assets expensive, and those assets will stay. The policy may not have been designed with that objective. But in a complex world, intent matters less than outcome. And the outcome here is clear. A once seamless market is being bent along national borders. To better understand this feeling of, you can get in, but you can't get out, we need a metaphor. An image simple enough to capture the entire mechanism we have just analyzed. There is an old metaphor in commodity trading that bullion banks understand very well. They call it the roach motel. A hotel for cockroaches. Roaches can get in, but they cannot get out. For decades, the silver market was never a roach motel. It was like a river. Metal flowed from one place to another, following price, following demand, following spreads, in and out, gone and back again. No one thought much about it because it always worked. But tariffs have turned the US border into a revolving door with a broken hinge. Silver can step in very easily. There are no major barriers. But when it tries to turn around, the door slams shut with a tax bill. No locks, no police, just costs high enough, and behavior changes on its own. So silver checks in to the US system, and no longer checks out. Not because anyone is holding it by force, but because no one dares to pay the price to take it out. This metaphor matters because it shows that the core of the problem is not market sentiment, but the geometry of flow. When the geometry changes, all old models become useless. And if we truly are inside a roach motel, then the next question is not, will the price go up or down, but when does the trap actually tighten? At this point, one very important thing must be clarified. What we are discussing is not a prophecy, and certainly not a definitive claim that this will happen on day X. In commodity markets, especially the silver market, everything unfolds conditionally. And precisely because of that, the only warning that has value is an if-then warning. If in the coming sessions you begin to see silver prices in London rising faster than in New York, while that gap is no longer closed within a few hours as it used to be, then that is no longer noise. It is the first sign of real bifurcation. Once a price spread persists long enough that industry players stop trying to arbitrage it away, the market has entered a new state. If indicators, such as spreads, EFP or lease rates, begin to widen abnormally, that is a signal that hedging models are breaking. Banks do not like to talk about this publicly, but when hedges stop balancing, they are forced to reduce positions. And when the largest sellers reduce selling, the natural downward pressure on price weakens. If in London, the conversion time from unallocated to allocated accounts is extended, or new terms appear that sound very technical That is the scent of physical stress. On paper, everything still looks fine. But in the vaults, there may not be enough metal to satisfy all delivery demands at once. If in the United States you observe something that sounds paradoxical, spot prices barely move, but physical silver premiums rise quickly, deliveries slow, and dealers start quoting prices daily instead of weekly, pay attention. That is replacement cost speaking to you, not the chart. The key point is this: you do not need to believe any commentary, including this one. You only need to observe the things that are hard to fake: persistent price spreads, delivery times, and real-world replacement costs. And when those signals appear together, the question is no longer, is there a problem? But how far the problem has already spread. If the previous section was conditional warnings, then this is the observation protocol. Not to act rashly, but to know where you are in the cycle. In a market where logistics determine price, the three signals below often speak the truth earlier than any chart. Signal 1. Vault flows. Track the rhythm of withdrawals and deposits at major vaults. You do not need to obsess over daily numbers. Look at the trend. If inventories in New York stop flowing out as they used to, while London continues to see its available, unencumbered inventory decline, that is a sign that a one-way valve is operating. It is especially important to distinguish between total inventory and deliverable inventory. The market may look full on reports, but if the deliverable portion shrinks, real stress has already appeared. Signal 2. Spreads and lease rates. When logistics break down, prices do not just split, time costs reveal themselves as well. Widening spreads between centers, expanding EFPs, rising lease rates. All are expressions of the fact that balance is no longer free. Pay attention to the persistence of the spread, not just its size. A small but persistent spread is often more concerning than a brief spike that quickly reverses, because it shows that arbitrage has stopped trying. Signal 3. Premiums and real life. If all three light up together, the market is changing phase. If only one appears, be patient. The key is not to confuse noise with structure. In short, do not look only at price. When all three point in the same direction, the market has spoken very clearly. It just did not speak through a chart. At this point, we return to a question that seems simple, but has become harder to answer than ever. What is the real price of silver? Is it the number flashing on a screen in New York? Is it the higher price in London with immediate delivery? Or is it the price you must pay to replace that same amount of silver in the real world, with delivery time and premiums attached? Try a very ordinary scenario. If you sell the silver you are holding today at spot, can you buy back the same amount tomorrow? If the answer is yes but more expensive, or yes but with a wait, then that gap is where the truth lies. In a fragmented market, price is no longer a single number, but a set of conditions. So when London quotes one level, New York another, and dealers a third, whom do you believe? Which market reflects true scarcity? The one that delivers fastest, or the one protected by tariff walls? There is no single answer for everyone. But how you answer that question will determine where you stand in this cycle. And that is what I want you to think about, and then share in the comments. If you have made it this far, you have probably realized that the core of this analysis is not about a specific price number. It is about mechanism, about how flows are bent, about logistics changing faster than charts. And if you find analyses like this useful, moving from geography and tariffs to the behavior of people in vaults, rather than just traders on screens, then you know you are in the right place. I am not advising you to buy or sell. I am advising you to watch the right things. When you look at inventories, spreads, and delivery times, you do not need to believe anyone's words. The market will speak for itself, very quietly, but very clearly. In the next video, we will shift the focus entirely to London. More specifically, what happens when a physical market built on unallocated accounts is cut off from resupply? How does a run in metals differ from a traditional bank run? And what might Monday's opening reveal, not on the chart, but in how participants delay, adjust, and avoid delivery obligations? If you want to continue following this analysis series, subscribe to the channel. No loud notifications needed. Just stay. In times like these, staying with the mechanism matters more than chasing breaking news. We will meet again in the next part, where the story is no longer about whether there is a problem, but about how the problem is revealing itself.